One, Joe Bladdock here again. My live stream on Facebook and YouTube for some reason cut out, so I'm back live here again. If you haven't, uh, if you're just tuning in now, we're talking about self-employed mortgages in Canada. There are two very different programs available. One is the tax return program, and the other one's the bank statement program. And through the tax return program, the main thing I'm seeing is that people don't qualify for what they think they qualify for. So if you have 100,000 or 150,000 gross income, you think you'll qualify for quite a bit. But really, what the banks look at is the net income after deductions, like your car payments, your car interest, your mileage, all that. So what I'm seeing folks do that want to qualify for the most with the big banks, like the Big Red, the Big Green, those banks, they actually don't claim all their write-offs and pay higher income tax. And that actually qualifies you for more mortgage money on the A side. I know that seems ridiculous to not claim all your expenses because you're going to have to pay more income tax, you're going to have to pay more CPP, but that actually qualifies you for more money. For example, if you have deductions that bring your $150,000 gross income to $20,000, which I see quite often, these accountants, they were able to find all these deductions. Your personal home, you're using that for part of your business, your car, using that for your business, you have another vehicle for your business, you have equipment that you've bought for your business, you have subcontractors for your business. That all counts towards uh, your write-offs. And then all these write-offs then really bring down the income you can qualify with for a lender. So when you're filing taxes for yourself, the main goal here is to use an appropriate amount of write-off so your net income on your taxes is reasonable to be able to qualify for a mortgage at the best A rates, and also reasonable for you in terms of how much tax and CPP you will have to pay on that income. Now, if you don't want to go that direction, another way to go is what's called the bank statement program. And with the bank statement program, you can qualify for sometimes hundreds of thousands of dollars more. And that's a big deal because when you qualify for hundreds of thousands of dollars more, you all of a sudden can get into a much different uh, purchase price range. So your real estate agent can really help you find that house you're looking for. So, for example, when you're looking at the bank statement program, they don't really count expenses like your personal use of your home. They won't really count mileage as an expense. They won't really count your uh, equipment because these are one-time expenses, right? They are looking specifically for recurring expenses. So what does that mean? Well, recurring expenses are things like your business insurance, your subcontractors, your uh, perhaps your uh, phone systems, your car payments, and all those are recurring expenses. And they look at your bank statements for the last 6 to 12 months, add that all up, annualize it, and then we look at your recurring expenses specifically, and minus those out. So if you have a $150,000 gross income, let's look at that scenario. And your net income on your taxes is 20 grand, but at the same time, your bank statement income shows that your gross income is 150, but your net income after recurring expenses only is say 90,000. Then all of a sudden it's 90,000 versus 20,000, and 20,000 will qualify you for a mortgage of approximately 100 grand, whereas 90,000 will qualify you for a mortgage of approximately 400 grand. So 4 times the amount of qualifying power. And not only do these bank statement programs allow you to use bank statements to prove your income instead of your income taxes, but these lenders also have more lenient qualifying ratios. So when you're qualifying for that file, you're not only able to use more income from your self-employed business, but we're able to qualify for more mortgage money because the ratios are more relaxed. And when you're dealing with those two situations, you're able to qualify for much more mortgage money, a much more realistic view of your income, and it gives you more of what you're expecting to qualify for. Now, there are some drawbacks with this bank statement program. There are drawbacks in the sense that they're not going to be with the A lender that you're used to dealing with. They're with mortgage only lenders that specifically work with mortgage brokers. And when you work with a mortgage broker, the broker will shop your rate around to make sure they're getting you the best interest rate, best deal, best situation for your purposes. But you're going to notice a couple of different things. And one of those things is these mortgage companies do charge a premium on their interest rate. So right now, when you're getting a mortgage through the Big Red, a 5-year fixed mortgage is just about a percent under prime. So prime right now is sitting at 7.2%. Big Red right now, they have a 5-year fixed mortgage at 6.19%. That's their 5-year fixed. Whereas if you're getting a mortgage through a bank statement program lender, they're going to be more at prime. So prime right now is 7.2%. So you'll probably receive a rate around 7.2%. Still a very good rate. Well, not a very good rate compared to 3 years ago, but very good rate competitively right now. But at the same time, not as good as the AAA lenders. And with that, you may pay a little more per month versus an A lender, but at the same time, you're actually going to be able to qualify for that mortgage versus not qualifying for that mortgage at all. And that's a big deal for some folks. It's a great thing if you're even a commission salesperson, because if you're a commission salesperson, you receive a T4A from your employer, and you usually have to pay your own taxes at the end of the year as well. And when you're paying your own taxes, you're going to have all those write-offs as well. And with a lender, you're going to qualify for your net income on your taxes. So that's after all your deductions again. But if you're a commission salesperson, specifically like a real estate agent or someone like myself, like a mortgage broker or some other kind of sales position, quite often what these lenders will use is they'll use your gross income, your T4A income. And then all of a sudden, we're able to use such a higher amount of income for you because we're not looking at your deductions. And that's a big deal for a lot of folks because then they can qualify for exactly what they want or more so of what they want. So just to recap, if you're just joining me now, my name is Joe Bladek. We're celebrating 150 episodes today on Canadian Mortgage Weekly, Canada's only weekly video mortgage news podcast. We started this podcast in 2020 during COVID. Really pumped to be here with you all today, sharing this information on self-employed mortgages in 2023. Specifically, what we're looking at is the two different programs that are available for most self-employed individuals, and that is the programs available through AAA lenders like Big Red and Big Green that look at your net income on your taxes to qualify you for that mortgage. And when we say net income on your taxes, we are looking at the income after all deductions, all mileage, everything deducted off. So that income usually is very small compared to what your gross income may be. And you get the best rates, best terms for that type of mortgage. And what a lot of people do in those situations is they try to claim less write-offs each year to be able to keep their net income high on their taxes so they keep getting the best rates when they need a mortgage with their A lender, AAA lender. Now, the other program is a manual underwriting business bank statement program. It's a completely different program altogether. They're not available through any of the big AAA banks. They're available through brokers, through banks that are mortgage-only banks. And what these banks do is they look at your total income on your bank statements for the last 12 months. and they minus out recurring expenses like car insurance, business insurance, car payments, subcontractor payments, uh, phone system bills, bills that are recurring to the business. And we don't count things like business use of home or mileage or capital cost allowance, which can keep your income for qualifying purposes higher. And these lenders also use more lenient lending ratios, allowing you to qualify for much more mortgage money when you're self employed. And in that case, it makes more sense to make sure that when you're dealing with a mortgage broker, to get them to look at both scenarios and see which one is better for you. Just this week, this is why I'm doing this program, is just this week I had folks that are self-employed and their income is over $100,000 a year. And their A lender came back to them saying, we're only going to use the net income. And because the net income was variable between the first and second year, because they're looking at the last 2 years, they decided to use the lower of the 2 years, which was extremely low. And they ended up qualifying this person for a mortgage of about $50,000. Whereas if they went with a business bank statement program, they could have qualified for about $400,000 more money. So I couldn't believe how much of a difference that was. We got to bully landlords. That's how we save Canada. Well, that's for a different program, but I really appreciate your comment. We're talking about self-employed mortgages today, and specifically those that want to qualify for something reasonable. So these lenders are out there. They usually charge prime rate versus prime minus one on fixed rates. And you can get prime rate on these deals. And we can get a pre-qualification done. Mind you, the pre-qualification does change month to month because they are looking at your most recent 12 months bank statements. So the income that we use to qualify your child can change month to month based on your business dealings. So with that in mind, if you have any questions, my name is Joe Bladek. You can send me an email. I've been doing these mortgages for 13 years now, and I can help you qualify for the most money when you're getting a mortgage when you're self-employed. There are some other stipulations that you'd want to make sure that you talk to your broker with about these mortgages. Some of these lenders do charge lender fees, which can amount to 1 or 2% of the mortgage cost. A lot of customers of mine tell me, well, if I was paying CMHC, that would be just as much money. So it kind of makes sense for them. But those are some situations there. Maybe I'll do some more videos about this in the future. But in the meantime, I did want to go into some of the details about what's happening in the market this week, specifically with real estate and mortgages. One of the things I'm noticing is that the US Fed yesterday raised their rate by a quarter point. And Jerome Powell, I did watch most of that live stream from Jerome. It was talking about how there is a quarter point rate increase needed right now because inflation, although it's been dropping, not dropping fast enough. Right now, inflation for the United States is sitting at 3%, and that's as of June 2023. That is the most recent figure. It's down from 4.1% in May and 4.9% in April. That's a big decrease. However, it's not fast enough, and that's why the US Fed did increase their target rate by a quarter point yesterday. Also noted that future rate hikes are not off the table. And that was very concerning. There was a lot of reporters asking, what does that mean? There's also what's called the terminal rate. And the terminal rate that Jerome Powell is using is 5.5%. That is the rate that they believe will be the highest rate they will hit. But he also did say that 2 more rate hikes are on the table, which could indicate 2 more quarter point increases. And why am I saying this? Well, Canada's inflation rate has been dropping, but also not very quickly. We're also influenced quite a bit by the United States government. And if the United States government increases rates, we need to sometimes increase rates, or else our dollar and relation to the the Canadian dollar in relation to the US dollar might go to a place where we don't want it to go. So we are quite heavily influenced by the United States. And I don't think because of that happening on July 26th, a rate hike is off the table for Canada right now. Looking at Canada's inflation rate, we are currently sitting at 2.8%. We're closer to that 2% mark than the United States is. However, we have seen a wavering of inflation. We were at 4.3 in March. We went up to 4.4 in April, down to 3.4 in May, and now at 2.8 for June. So we have inflation numbers for both the United States and Canada coming out around the middle of August. Let's see here. They will be released. When will they come out? August 15th. So we should have those numbers for you in about 3 weeks. And then we'll be able to see if inflation is not dropping fast enough, they will probably keep a rate hike on the table for September the 6th of 2023, which is Wednesday, September 6th. Please join me here live on Canadian Mortgage Weekly. I'll be covering this news live on my show at that time, and we'll be looking at seeing whether or not we think rates will go up, and we'll do a live announcement as well on air. One of the things Jerome Powell did say, though, is that we need U.S. jobs, like the unemployment rate, to go up quite considerably before we even stop and start lowering rates. So what does that mean? Well, that means that the economy is doing well. He was saying things like, inflation's coming down, but there's still tons of activity in the job market. There's more people looking for jobs, and there's lots of companies needing workers. And because that's the case, and the unemployment rate hasn't really been changing very much, it's been steady, they don't want to lower rates. And the only way Jerome Powell said that they would lower rates is if unemployment starts to really go up. And in Canada, we've been seeing 2 months of higher unemployment for June and May. But the amount that unemployment has gone up is very, very, very small. We've seen unemployment go up 0.2% in May and 0.2% in June. Very small numbers. Right now, unemployment in Canada is 5.4%. So we'll have to see if it goes up again in August. We'll have that number probably first or second week of August. And that will really contribute to the Bank of Canada's decision as well on September the 6th. For example, if unemployment rate really doesn't change or goes down just very small, then there's no possible way that there'll be a rate decrease. However, if unemployment does jump by a whole percentage point or more, like 1.0 or higher, then we could see a possibility of a rate pause or rate decrease. But I don't think that's going to happen because our job market has been very strong. A lot of companies are still looking for workers. Every time I talk to anyone in the industry that is working, their companies are hiring. They're having a hard time keeping workers. And because of that, job market's really strong. And another thing I look at is the bond yield. And I talk about that a lot on my show, and it's the 5-year bond yield specifically. The 5-year bond yield has a lot to do with fixed rates in Canada. And when I say that, the banks actually base their 5-year fixed rate off of the 5-year Canadian bond yield, and they look at the spread between. So right now, the 5-year Canadian bond yield is sitting at 3.954% as of 11:57 a.m. on July 27th, 2023. And that is quite a high, actually. It's the highest it's been. Really, this is the highest that the bond yield has been since 2007. So what does that tell you? I mean, 2007, that was the last financial crisis. And the last financial crisis really, there was a recession shortly after that. So depending on how high this goes, it's going to continue pushing fixed rates higher. I know that right now fixed rates are extremely high. They're around the high 5s to low 6%. Big Green right now sitting at the high 5s, Big Red sitting at the low 6s. And fixed rates right now, they're not fun. I mean, anyone that's getting a renewal right now that had a 2% rate is facing a renewal that has a rate that is 3 times higher. For anyone, for any family, that is a huge blow to their financial situation and a huge adjustment to their budget. I know that a lot of my clients that have these mortgages coming up for renewal, they're also locked into their lender because the rate has gone so much higher. They even can't qualify for switching that mortgage they qualified for before previously to a new lender because their income no longer can cover that mortgage at today's income ratios. So they're almost stuck with that lender and they cannot move. So I always recommend starting early. You can start looking for and shopping for renewal 4 months prior to your maturity date. That's when I suggest starting to call other lenders, other banks, other brokers, and get some quotes. Call your lenders, see what they can offer you as well with the best rate that they have, and just shop around. So by the time your maturity date comes, you've done whatever you can. And if they offer early renewal, don't take it because even though that rate might be lower than what's currently out there, you'll start paying that higher rate right away if you take an early renewal versus writing out that 1 or 2% rate until your maturity date. Last metric I wanted to look at is the Canadian average national house price. And for the last 4 months, we have seen the national average Canadian house price go up. But last most recent month, it did go down 3%. Now, is that a big deal? Well, a lot of the times what's happening is that the Bank of Canada, not the Bank of Canada, the average national house price does go down slightly for the summer because during the summer we have less activity and it goes back up in September, usually when families have their kids back in school and they're starting to shop for houses and sell houses and they have more time for that sort of thing. So does usually stagger a little bit in the summer, so it is expected. But right now, the average national Canadian house price is sitting at $709,218. And for a single person to buy an average an average home in Canada, I can't believe it, but that person needs to have an income of approximately $175,000 to afford that home as a first-time home buyer, putting the minimum down payment on that house. So quite a large income required to buy the average home in Canada. And if you're looking to get into a home and you need some guidance, I always suggest call a broker. If you don't have a broker, my name is Joe Bladdock. I've been in the business now for 13 years, and I would look forward to sitting down with you over a Zoom or phone meeting and talking about your financial situation and giving you some mortgage advice based on where you are right now looking for a home. Anyway, so if you're just joining me right now, we talked about self-employed mortgages in Canada. We covered off the two main programs. One is the bank statement program, and the other is the tax return program. Tax return mortgages are the self-employed mortgage programs available through AAA lenders like your Big Reds and your Big Greens. They look at your net income on your tax returns, and they look at over the last 2 years versus looking at bank statements. Bank statement program usually allows you to qualify for more money at a slightly higher interest rate. And the interest rate's usually at prime versus less than prime with the AAA lender. So it's still a very competitive rate. And if you're looking at getting qualified for a mortgage with self-employed income, I would definitely recommend to talk to your broker and make sure they give you the option to look at what you pre-qualify for based on bank statements and tax returns. And that's all I have for you today. My name is Joe Bladdock. Thanks for watching Canadian Mortgage Weekly, Canada's only weekly video mortgage news podcast today for Thursday, July 27th. We'll see you next week as I celebrate episode 151. Today was episode 150, and looking forward to continuing to provide mortgage advice to all Canadians across Canada going forward. I hope you have a great day. And if you're watching on TikTok or Instagram or Facebook or YouTube or LinkedIn, hit that plus, follow my account so you can be notified for future live streams and would love to connect with you over social